And our next guest says that while strong consumer demand and government spending have kept GDP up, the data is inconsistent with inflation being under control. Is joining us now, Hoover Institution distinguished visiting fellow Kevin Hassett. He served as chairman of the Council of Economic Advisors and a senior advisor to former President Trump. Kevin, welcome. It's good to see you as always. Would you at least acknowledge that this is not like a normal sort of an economy that you can just put a label on and say it's just like monolithic one way or the other? It's like there's something for everyone depending on what your viewpoint is.
You know, and I've been looking at the data lately, Joe, and you know, I think we're getting close to the 30th year that I've been coming on Squawk Box. I'm not kidding. And back then in the 90s, we were talking
because
about,
it was 1995. You're right. So it will be next year.
But we were talking about the internet, and I can remember that everybody saying, "Oh, this internet's going to be a really big thing," but the market kept getting surprised on the upside by the internet, and so you had 5 years in a row with what they average about 30% returns. And I'm not saying that we know that that's what's going to happen now, but you've got all these really smart people like Eric Schmidt and Bill Gates saying that artificial intelligence is bigger than the internet. And so as market watchers and economists, we should start to look for signs that something like the late 90s might be happening. And if that does happen, you might remember that the fiscal policy and all that other stuff became much less important because of the productivity boom that eventually was in the numbers from computers. And right now, Eric Brynjolfsson, my colleague out at Stanford, has been doing a lot of really path-breaking work showing that the gains from switching AI on at companies can be 10 to 20% productivity increases in a month or two. As you wonder, why are equities doing well? Why are profits soaring? It's because probably we're starting to see like scientific evidence that the AI is the big major story.
So, Kevin, you think it's already
we've got a
impacting?
really irresponsible. I would just say just one last sentence against that backdrop. We've got a really irresponsible spending policy, massive government debt, and it just doesn't look like. So on the one hand, you could think of a lot of bad things could happen, but on the other hand, good things continue to happen.
Kevin, but there's some sort of view that this might be premature insofar as you have to make the AI case, you have to believe that it's actually impacting employment. And you keep looking at these employment numbers, and they keep going up and up and up and up. You would think that that would have to reverse to capture the productivity numbers you're talking about. The only way that happens is for actually there to be less employment, not more, right?
Well, or the people that are working become a lot more productive. You know, we're kind of at full employment. And so if you want to have growth, then you got to take the people who are in jobs right now and jack up their productivity. If you do that, labor input goes up and GDP can. But you're right to be skeptical for sure. And what we have now in terms of hard evidence is 3 or 4 really interesting studies where they did controlled experiments and stuff. But the studies are in places like call centers and so on where you would expect to see huge effects. And so it's something that might be happening. But when I'm trying to think about what's going on with profits and markets, then it's kind of the best explanation for me. And I mentioned in my email to you guys that one of the things that's really striking while markets continue to surprise on the upside is that capital spending has been going south 2 quarters in a row. And right now, if you look at GDP now at the Atlanta Fed, it's going to decline for the third quarter in a row. And so supply is going down while demand is going up because of lots of government spending and consumers staying strong. And that's a recipe for inflation.
Right. So do you think we're in restrictive territory? We keep asking everyone that today. And if you were the head of the Fed, and I'm going to ask you about that in a second, but if you were the head of the Fed, would you be considering cutting rates this year?
There are risks on both sides, and I can think of really good things that could happen. And again, the productivity shock would be a positive supply shock, which would put downward pressure on inflation. And so if we get really convinced that this AI story is real, then I could imagine that you could take your the foot off or off the brake a little bit. But on the other hand, I respect what the Fed's been doing. They've been signaling that maybe they're getting ready to cut, but then when the data come in stronger, then they've responded to the data. And that's what a responsible Fed should do. The thing that bothers me is with all the strength we've seen, right? The last 2 quarters averaged, 3.5%, 4% GDP growth, inflation. If you take the last 3 months and annualize it, running about 4%. All that stuff suggests the Fed needs to be, pretty aggressive about saying, "Hey guys, we're not there yet." And yet, market futures are pricing in a cut in June, and I think that that's kind of a communication error. I don't think the data are going to allow them to do that, and I think that's the one thing I disagree with what Jay Powell's been doing right now, is signaling that there might be cuts coming soon, because there's just nothing like that in the data to me.
What are those letters behind you? That's a very distinctive signature. Is that 45?
Those are. Those are the, I have them right here in my office. Those are the notes that appointed me chairman of the Council of Economic Advisor and member of the Council of Economic
That's 45 signature on the right, isn't it?
That is Donald J. Trump's
It's very distinctive. So that's not a letter asking you to be the next Fed chief from that's not what we can't see the text.
Would happen.
Would you take that job? Would anyone take that job?
It's crazy to speculate about stuff right now. It's like the cart before the horse, and we don't really even have a horse yet. And so I think the appropriate thing to do is to talk about policy for a person like me, and let people think about whether they think those policy views are the views of someone you agree with.
Unfortunately, you just gave every modern monetary theorist a get out of jail free card, because AI is going to solve our $34 trillion worth of built-up debt through productivity.
I said that's a risk to keep an eye on, right? So we start to see it in the productivity numbers. We start to see inflation going down. Then the AI thing is real, but it's not real yet.
It's not real yet, but why do we not see more crowding out? Why are we not at 100 and whatever percent of debt to GDP, headed to 150 or whatever we're headed to? Just because of what we've already spent. Why isn't there more trepidation, do you think, Kevin? Because of AI?
No, I think that what's been going on in the U.S. is something that's not sustainable, but it can last for a while. Think about it this way, Joe, that nominal GDP went up by less than nominal debt held by the public last year. So it's kind of like you made $100,000 in income, but your debts went up by 150, and then at the end of the year, you're saying, well, was that a good year? And if you're only looking at the income, it feels like a good year, but you should look at the debt too. And, talking about future Fed policy, the thing that I'd have to say, though, is that if the government continues to spend so irresponsibly, then getting inflation under control is extremely unlikely for the Fed, because they're, again, borrowing 150 to give you 100 in income. And where's the 50 come from? And you're right to be skeptical about it. And the Fed monetary policy was very accommodating at the beginning, and we're still unwinding that. And I think that in the end, it's if there's not some kind of fiscal consolidation in the U.S., then the Fed's job looks really, really difficult.